Alright, what's up guys? James here from jamesdforsyth.com, and I just kind of wanted to come on here and give some clarification and actually talk about to where I, I don't really want to say that I was wrong for the video that I gave yesterday, talking about how where I was confused on like how bank reserves and if they're different between like excuse me, for bank reserves whenever or during quantitative tightening, are like I didn't know if they were treated differently, whether or not they were rolling off of the balance sheet or just being sold outright, right? In terms of the actual process from the Federal Reserve. And so what actually happened and why I had that misunderstanding was because I wasn't viewing the whole picture, right? I was trying to think of it and trying to understand it from a transaction basis, right? Like the actual between the Fed and the primary dealer, which isn't the whole picture, obviously, but I was trying to narrow it down to kind of I guess as simple of a base case as I could muster, so that I could actually understand the dynamic, much like the understanding I forgot what I called it, like step by step through repo transactions post I did. There's a video on the channel as well of me literally going through, okay, like they buy from here, money here, collateral here, or securities here, and so on. Like literally walking myself through it and hoping you guys, hopefully you guys would find that helpful by actually seeing like verbatim my thought process, trying to understand it, right? And I was trying to do the same thing out loud with the video yesterday on bank reserves, but by basically narrowing down the situation to between just the Fed and the primary dealer that they were dealing with for whatever. Pick an example, pick one. Basically, I was saying during quantitative easing, when the Fed purchases the Treasury, as an example, whatever security they happen to be buying from the primary dealer, the security, in this case Treasury, goes to the Fed, and the Fed creates bank reserves to purchase it. Those bank reserves are on the asset side of the primary dealer, right? And so what I was not thinking about was the Treasury and the TGA. And so this would be with respect specifically to Treasuries. Obviously, it's the Treasuries. Treasury pays for it, right? They're a liability of the government, the Treasury Department. And so basically, I was thinking, if they're rolling off the balance sheet, how is that different from if the Fed is selling it outright? Well, if the Fed sells it back, those bank reserves just basically cancel out, right? The bank reserves that they created to purchase the original Treasury to begin with during QE would essentially be destroyed, for lack of a better term, when they sell it off, right? That's the whole purpose of the bank reserves, is basically like accounting, kind of like a token, like an interbank token, so to speak. I've heard it described as. So there's that. But in the case of it rolling off of the balance sheet of the Fed for quantitative tightening, which is what was predominantly used during the previous quantitative tightening cycle, right? So last time the Fed did QT, they did it mostly by rolling treasuries off of the balance sheet, not replenishing them, right? And so essentially what's happening is when they're rolling off, they're maturing. And so basically the Treasury is paying the Fed because they're holding the securities, right? And so for some reason, I was thinking of Treasuries as an example of kind of a general security, but I wasn't like, okay, actually thinking through like what is the characteristics of the Treasury and so on. And if it's like an agency-backed security, it'll be the same thing, but whatever agency it is. So like if it's a mortgage-backed security, then it would be Fannie or Freddie, right? Whatever that entity happens to be. It's just I picked Treasuries, and so in this case it would be the Treasury Department, right? So in the end, it's because the collateral, not really collateral, I guess, since it's not being used as such in this specific example. I'm still thinking about repo and other stuff as well, so ignore that part. Not collateral, but in this case. But it's essentially the Treasury pays off the debt, right? the Treasury Department pays off the Treasury that the Treasury bill or note, whatever it happens to be, that the Fed is owning. And that, so essentially what's happening is that same exact dynamic that's happening between the Fed and the primary dealer when they just sell it right off, is happening when is happening when the Treasury pays off that debt, right, to the Fed. It's just, instead of it being with the reserve account of, or whatever the bank may be for the primary dealer, it's happening through the TGA for the Treasury instead. So it's kind of, I wasn't thinking like the whole picture itself, and also specifically with like, what exactly are we using these fixed income instruments in a way. And so that's kind of where my misunderstanding was. And I just wanted to hop on here and kind of clarify that, because I think that it's important. Because I don't really want to, I didn't mean for it to be misleading if it was. It was more for me actively thinking out loud, which I even started with that as the premise, so shouldn't have misled anything or anyone, but just kind of going through it and thinking through like the dynamics itself and trying to understand like what exactly is happening. Not because I'm one of those kind of people to where it's like, okay, yeah, like, oh, the Fed's doing QE. Okay, what exactly, right? It's like I don't know if it's just because I'm that type of nerd or whatever, that I actually want to understand like, okay, yes, QE, or in this case QT, but like specifically what is happening throughout the process, because stuff is moving, assets and liabilities are moving on the balance sheet, so like what exactly is happening there, and so on, right? So really trying to understand that and kind of grasp it in a way, because it's one of the problems that arise, and this is going to be a little bit of a rabbit hole, but I kind of just want to say it anyway. But one of the things that I find interesting is like how you can kind of define different types of money and what it's used as, right? And so I've talked a little bit about this from after, I think it was in the review I did of Joseph Wang's book, Central Banking 101, which was essentially talking about like how you have multiple forms of money. It's just their liabilities of different entities. And so you have commercial bank deposits, which are liabilities of the commercial banks, and then that's your bank account. And then you have cash or bank reserves, which are usable by they have different end users, I should say. Like an individual or business can't have bank reserves, only depository institutions that are eligible for them can. And then cash is just physical. Everyone's pretty much familiar with cash. So there's that. And then there's, I talked about bank deposits. And then there's the treasuries, right? And so kind of thinking of treasuries as a money itself. And that's one thing that sometimes when you realize that, it's kind of like, it kind of feels like you're mentally kind of competing between the different types of money when you're trying to think of the transactions in a way, at least when you're originally starting to think them through and try to understand them. That's one thing I've noticed. And so it's hard not to conflate the two, right? And so treasuries are essentially like interest-bearing money, to where like the currency itself bears interest. Kind of like we've been talking about a few times with the central bank digital currency videos, about one of the possibilities that they've been thinking about is having a central bank digital currency in which it in of itself bears interest. And then they're talking about like, interest and price caps and limiting how much you could transfer, stuff like that, whatever. Different topic. But yeah, and so basically thinking of treasuries as money in and of itself in a way, or at least in currency, if you want to pull up the whole money versus currency argument. But really what I'm trying to get at is, so treasuries are a form of currency in the same way, mostly because they're used as collateral for like the repo market in specific ways. And then just in general, it's deemed as pristine collateral, right? And so it's essentially used as its own form of currency, but by different players. Just the same way, like, you can't hold bank reserves. Treasuries aren't really a form of currency for you, but if you're like a multi-billion-dollar hedge fund or pension fund or money market fund or whatever, dealing in the repo market and stuff like that, it really kind of is. And so that's really what you're trying to grab for. At least there's some arguments for that, right? Let's say it this way: the most, I don't want to say intelligent, but the most well thought out and coherent arguments I've heard, specifically in terms of kind of the collateral, in terms of what's going on in like the repo market and stuff, and what's really like the point is having treasuries as collateral, and that's really the main focus. Makes a lot more sense than, oh, they're just flush with bank reserves, so they have to throw it somewhere. Whereas, barring the interest on excess reserves that depository institutions receive, I don't see much of a utility for bank reserves in and of themselves, except for some accounting rules that you have to deal with, like how they're weighted on for balance sheet mechanics in terms of like risk adjusted and how much they could, was it the SLR, I believe. Haven't done too much research into that one specifically, so I don't remember the technicalities of it, but that sounds about right, to where it really depends on the risk. It's kind of like each type of asset a bank has on their balance sheet has like a specific risk ratio or whatever, to where they can lever up, or leverage ratio, a specific leverage ratio based upon the risk of that asset, right? But anyways, end of my rant right here. I don't want to go too far down and just kind of keep rambling on for a bit, but initial thoughts, I wanted to kind of clarify and just kind of put that out there. That's the whole point of the videos. But yeah, anyways, I hope you guys have a good night, and I'll see you on the next one.